Welcome to our video on interest rates. Interest rates are an important part of our financial lives, affecting everything from the cost of borrowing to the state of the economy. In this video, we'll explain what interest rates are, how they work, and why they matter. What are interest rates? Interest rates is defined as the cost of borrowing money, expressed as a percentage of the amount borrowed. Let us take a look at two bank offerings for our example. Let's look at the first bank's offering. They are willing to lend you $1,000 with a 5% interest rate. To figure out the interest amount you'd pay to borrow $1,000 from that bank, you would multiply $1,000, also known as the principal, by 0.05, which is the interest rate they are charging for the loan, which would show that there is an $50 interest you would pay to borrow that $1,000. The total amount you would have to pay back is $1,050. That includes the $1,000 that you want to borrow plus the interest you would include for the privilege of getting that loan. Let's look at another bank's offering. They are willing to lend you $1,000 with a 10% in interest rate. Using the same math, we get an interest of $100. The total amount you would have to pay back is $1,100. Which bank would you borrow $1,000 from? Bank 1 or Bank 2? Bank 1, because they are $50 cheaper. How are interest rates calculated? Interest rates are calculated based on a combination of factors such as the type of loan, the borrower's creditworthiness, and market conditions. For example, a mortgage loan may have a lower interest rate than a personal loan because it's secured by the value of the property. Similarly, borrowers with good credit scores may qualify for lower interest rates than those with poor credit scores because they are less riskier from the bank's perspective. They are basically charging more to take on riskier loans. Why do interest rates matter? Interest rates matter because they affect the cost of borrowing, which in turn can impact the economy as a whole. We saw how it could affect you if you wanted to borrow $1,000. Imagine this at a larger scale where hundreds of millions of people are borrowing money. If interest rates go higher, it can discourage borrowing and spending, which can slow down economic growth. Lower interest rates, on the other hand, can encourage borrowing and spending, which can stimulate economic activity. Why do interest rates fluctuate? Interest rates can change frequently due to various factors, such as inflation and economic growth. Central banks, such as the Federal Reserve in the United States, have the power to adjust interest rates in an attempt to control inflation, which prevent prices of goods from increasing or promote economic growth. For example, if inflation is rising, the central bank may raise interest rates, which would making borrowing money more expensive, to encourage people to save more and spend less, which can help reduce demand for goods and services. The opposite would be true if the central bank want to encourage economic growth. They would lower interest rates, making it cheaper to borrow money so people can spend and stimulate the economy. There are both pros and cons to changing interest rates. On the one hand, lower interest rates can make it easier for people to borrow money and invest, which can stimulate economic growth. However, low interest rates can also lead to inflation and asset bubbles, which can have negative consequences. On the other hand, higher interest rates can help control inflation and make it easier for savers to earn more interest on their savings. However, high interest rates can also make it more difficult for people to borrow money and invest, which can lead to a decrease in economic growth. Interest rates are a critical component of our financial lives. By understanding how interest rates are calculated, why they matter, and the pros and cons of changing rates, we can make better financial decisions and appreciate the role that interest rates play in our economy. Thank you for watching, and don't forget to comment, like, and subscribe. We'll see you in the next video.